December 23rd, 1969. Phillips Petroleum strikes oil in Norwegian waters. The Ekofisk field, the first major discovery in the North Sea. 10 months later, British Petroleum strikes oil 90 miles away in British waters, the Forties field. Over 50 years, Norway pumped about 40 billion barrels of oil equivalent. Britain pumped about 43 billion, almost identical. Today, Norway's share sits in a sovereign wealth fund worth more than $2 trillion, which is close to $400,000 per Norwegian on paper. Britain's share, however, is spent. There is no fund. There never was one. This is the story of how two governments sold the same oil and only kept the money. Three things explain it: $30 against 11, what each government kept per barrel, one rule Norway wrote in 1990, and one number in Britain's own 2030 forecast. The last one is the part almost nobody has priced in. Let's start with the per barrel number because everything else is downstream of it. Two landlords with identical flats on the same street. One collects $30 a month, the other collects 11. Same building, same tenant. The gap is not the property though, it's the lease. That is the North Sea. Independent researchers at the Natural Resource Governance Institute estimates Norway's government captured around $30 of value per barrel produced. Britain's captured about 11. And before anyone says that the two halves of the sea were never the same, they weren't identical. And that is part of the story. Britain has now extracted about 90% of everything it is ever likely to produce. Norway has used a little over half. Some of it is that Norway decided how fast to drain the thing, and Britain handled that decision to the companies doing the drilling. Private operators drain fast. This is not a scandal. This is what they're here for. Norway did it with ownership, not just taxation. Its oil company, now called Equinor, is still about 2/3 owned by the state. A separate state vehicle, Petoro, holds direct stakes in the fields themselves. So the government is not a tax collector standing outside the business. It's actually inside as the owner. And on top of that, Norway applies a marginal rate of roughly 78% on petroleum profits, and has held it near that level since the 1970s under governments of the left and the right. Then in 1990, Norway did the part that actually matters. It created the government pension fund Global and wrote a rule around it. The state may spend the fund's expected long-run return, a few percent a year, and never the principal. That rule has survived every change of government since. It is, functionally speaking, a law against the most natural instinct in politics. Britain went the other way, and it did so deliberately. Prime Minister James Callaghan called North Sea oil a gift from God to the British economy in the late 1970s. Then, Britain sold its way out of owning any of it. Brit Oil was privatized through the 1980s, and by 1986, the UK government held no direct equity in the North Sea at all. Taxation was the only lever left, and it was cut rather than raised to keep the barrels flowing. The revenue was real. It just went into the annual budget and out again, as tax cuts, as spending, as ordinary government. Nothing was built to outlive the parliament that received it. And here is why that is not a history lesson. Britain's debt servicing bill had nearly tripled since 2019, from £39 billion a year to over £106 billion. That is the bill a Norwegian-style fund would be quietly paying down right now. Instead, it is paid by whoever holds British government debt, and by whoever pays British tax. Now, look at what Britain is doing with the oil that is left. Since 2022, the UK has stacked a windfall tax on top of ordinary corporation tax, the Energy Profits Levy. In 2024, Chancellor Rachel Reeves raised it again to 38%, taking the headline rate on North Sea profits to 78%, the same number as Norway's. And around the same time, Energy Secretary Ed Miliband stopped issuing licenses to explore new fields. Same headline rates, opposite result. Norway's 78% sits on top of state ownership and 50 years of predictability. Britain's 78% arrived suddenly on a declining basin with no ownership underneath it and no fund to feed. The consequence shows up in Britain's own numbers. Analysts at Stifel, working from the regulator's data, put expected North Sea output through 2050 down by around 40%, and 3.6 billion barrels to 2.1 billion. And the Office for Budget Responsibility has combined oil and gas receipts falling from about £6 billion in 2024 to 2025 to roughly £100 million by 2030 to 2031. $6 billion to almost nothing. Now, part of that fall is simply the windfall tax switching itself off. The Energy Profits Levy is written to end on March 31st of 2030, so Britain is not taxing its revenue to zero. It is doing something stranger. It's running a temporary tax on a terminal resource, and both of them run out at the same time. Which means the question was never whether the tax is too high, it's instead what Britain will have built by the time there is nothing left to tax. And the answer, on current plans, is nothing. Nothing at all. And now, the Strait of Hormuz. In April of 2026, when that crisis pushed energy prices back up, both countries got a live demonstration of what a fund like Norway's is actually for. Britain's response came in April of 2026. Chancellor Reeves raised a different levy, the Electricity Generator Levy, to 55% and extended it past its original end date to manage the fiscal hit. In the days around the shock, Britain's own National Institute of Economic and Social Research recorded 2-year gilt yields moving from 3.5 to 3.9% and 10-year yields from 4.25 to 4.5. And Norway sat on the other side of this identical shock. As Europe's largest gas supplier through the crisis, it was a net beneficiary of the same price spike that forced Britain into another emergency tax raise. One country has a $2 trillion shock absorber. The other has a bond market that reprices within 48 hours. So, is this simply Norway good, Britain bad? Of course not. And the measure you pick decides who wins. Measure national wealth by accumulated financial assets, and Norway, obviously, wins by a distance nobody can argue with. But if you measure it by size and depth of the economy, like capital markets, services, total output, and London is still operating at a scale Oslo does not approach. Same two countries, different ruler, different winner. Britain's case for Britain? Real current production and real jobs. Equinor says the Rosebank field alone would support around 1,600 jobs at peak construction, though it still does not have the final consent, and its critics put the lifetime figure far lower. And the deepest capital markets in Europe, a structural asset Norway's smaller financial system does not have. Britain's case against Britain? No fund, the higher government borrowing costs in the G7, and a debt load heading toward the mid-90s as a share of GDP in the early 2030s. Norway's case for Norway. Over $2 trillion, a 15.1% return in 2025, and insulation from exactly the shock that just hit Britain. Norway's case against Norway. The mainland economy, the part that is not oil, is soft, with growth revised down and unemployment just under 5% in March of 2026. And that $2 trillion number is a paper claim on shares nobody can actually withdraw. In the first 3 months of 2026, the fund lost $68 billion, down 1.9%, as the war hit global markets. It made most of it back by the end of April. But that is the point. The same conflict that paid Norway on gas took more than that in equities. Inside 90 days. No Norwegian has $400,000. Both countries hit the same oil, only one built something that survives a government losing an election. 2 readings, and both of them are defensible. British viewers might say that the money was not wasted, it was spent on lower taxes and public services for a generation, which is a legitimate choice, and that a fund is easy to demand in hindsight. But on the flip side, Norwegian viewers may say that a choice that leaves nothing behind is not a choice at all. It's instead consumption, and the proof of that is that one country still has money. So, dear viewer, you tell me, which one would you defend and why? Best argued answer for each side may get pinned on the next thing we publish. Now here's the number to hold on to, £850 billion. Now that is the fund independent estimates say Britain could be sitting on today from its own oil if it had copied its neighbor's structure from the start. Instead, it is now borrowing at the highest rate in the G7 to cover a bill that fund would have already been covering. That figure is just an estimate, and there are lower ones, around $400 billion. Even the low end is bigger than anything Britain actually has. So, Read the system underneath this one. The oil was never the advantage. The advantage was a rule written in 1990 that no later government could spend its way around. Britain never wrote that rule, and by the time anyone seriously proposed one, there was nothing left worth protecting. Now here's what to watch. Whether Britain's remaining North Sea receipts generate any real buffer before production effectively ends, Stifel's analysts already think the official revenue forecast is £10 billion too optimistic. And whether Norway's fund holds its value when the equity rally behind its last 2 record years finally cools. The first quarter of 2026 was a reminder that it does not only go up. One of those is a question about money, the other is a question about whether a rule can outlive the people who wrote it. There is a companion piece to this one on the channel, 2 neighbors that started 1989 at opposite ends of the Eastern Bloc, and swapped places because of a decision made in Brussels. It's on the screen now. Read the system, not the headline.